Welcome back to Investing Talk podcast.
Today we're looking at New Fortress Energy. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of New Fortress Energy, because this company, well, it really highlights a classic investing dilemma, doesn't it? You've got this extreme volatility matched with just staggering potential upside.
Okay, let's unpack this setup because it does seem, well, almost absurd. On one hand, the stock performance just screams distress.
Totally.
It's trading near its all-time lows right now, somewhere in that, $1.17 to $1.33 laying range, which is just a massive, devastating fall from its 52-week high. Wasn't that around $16.66?
It was. It's a collapse, basically. The market seems to have priced out pretty much all the optimism and is just laser focused on the risk.
But then the contradiction, and this is really the interesting part, is what Wall Street analysts are saying.
Right.
The consensus price target is $7.70. Now, doing math, that suggests a potential return of over 550% from where it is today.
It is huge.
And most of the ratings are strong buy or buy.
Which naturally leads you to ask, okay, why is the price stuck in the basement if, the so-called smart money sees 5x potential?
Exactly. What's the disconnect?
Well, the truth seems to be that the market isn't pricing growth potential right now. It's pricing survival risk.
That's a really key distinction. But, if the underlying business model is sound, shouldn't the price eventually reflect that growth?
Ideally, yes.
The fact that it isn't? Well, it suggests the risk of failure feels very immediate and very visible to traders.
Precisely. And you can see that risk reflected in the recent financials. We really need to look at the operational challenges here.
Right.
So while the trailing 12 months revenue looks okay, somewhere around $2.01 to $2.13 billion, the most recent quarter, Q2 2025, saw a really steep revenue drop, down 28.72% year over year. It only hit $301.7 million.
Okay, that recent drop is definitely concerning. But like you said, over $2 billion in the trailing year. Is the panic really just about one quarter's low number?
No.
Or is the market looking past that, terrified that these operational issues are hiding deeper structural problems? I mean, specifically with the debt load they're carrying.
Oh, it's absolutely. The balance sheet concerns driving a lot of this. But the income statement, it definitely shows the pain of the restructuring they're going through.
How so?
Well, the company posted a huge net loss, like negative $1.01 billion for the trailing 12 months.
Wow.
But it's really important for you, the listener, to realize this probably wasn't all just operational failure. A big chunk of that loss likely comes from non-cash charges, things like asset write-downs from restructuring projects, maybe asset sales they needed to do to raise cash.
Right, so they're shifting assets, taking paper losses maybe to try and stabilize the core business.
Exactly.
But the market just sees that headline number, $1 billion loss, and doesn't really care if it's paper or cash at that point.
That's the perception, yes. And even if we try to normalize for those write-downs and things, the operational struggles are still visible. Adjusted EBITDA for Q2 2025 was actually negative.
Negative EBITDA?
Yeah, it came in at minus $4 million. It points to ongoing transition costs, maybe difficulties ramping up newer projects smoothly. So the company is running negative free cash flow right now because of these big investments and the restructuring they have to do. And crucially, their leverage is significantly higher than most of their peers in the industry.
Okay, now we have to talk about what seems like the single biggest factor really spooking the market. The thing that kind of overrides everything else, the regulatory compliance and this debt situation.
Yes.
This feels like where the risk shifts from just financial stress to something more existential.
You're absolutely right. This is the massive overhang. So back in August 2025, New Fortress Energy got a non-compliance notice from Nasdaq.
Okay, why?
The reason was they delayed filing their Q2 2025 10Q report.
Right. And for anyone not familiar, the 10Q, that's the detailed quarterly financial report you have to file with the SEC. Delaying that, well, it sends a pretty clear signal to the market, doesn't it?
It really does. It basically says the financials are either too messy, too volatile, or maybe too dependent on negotiations that are still happening, so the company can't file accurately or on time.
It's basically the ultimate red flag, signaling severe financial pressure and probably, like you said, critical debt talks happening behind closed doors.
Exactly. So the resolution of those credit agreement talks and actually getting those delayed SEC filings submitted, those are the two absolutely massive near-term inflection points for this stock. Everything hinges on that.
And getting that Nasdaq notice, it effectively starts a timer, right? It ensures this whole situation has to resolve one way or another fairly soon.
It does. There's a ticking clock. The specific Nasdaq compliance deadline is February 16th, 2026. That's for both the Q2 and the delayed Q3 filings.
February 16th. So that means the next, 3 to 5 months are completely make or break. They have to regain compliance and sort out the balance sheet risk by then.
Yes. And failure to meet that deadline raises the very serious risk of being delisted from the Nasdaq.
So given that tight timeline, if you're thinking about buying the stock right here, right now, you are placing a very heavy bet on those debt negotiations succeeding, like immediately.
You absolutely are. But let's just step back for a second and look at the underlying business itself. The reason analysts haven't completely given up hope yet.
Okay.
What's the actual business moat here that keeps that long-term potential alive, even through all this financial turmoil?
Well, the interesting thing I see is their integrated LNG infrastructure strategy. It's not just that they own, say, terminals or ships separately.
Right.
They seem to control the entire vertical chain.
That's it, exactly. They operate across terminals, logistics, shipping, using those floating storage regasification units, FSRUs, and they even integrate into power generation. This vertical integration is the moat. It lets them theoretically reduce specific market risks, potentially maintain better margins, and offer a whole energy solution, especially to developing countries.
So they're aiming to build this globally diversified, hopefully resilient structure. That sounds great on paper, but where's the proof it's working right now, while these debt issues are burning so hot? Is there any evidence of strategic growth actually succeeding?
Well, we did see some concrete evidence recently. They secured a 5-year charter with EGAS for the Energo's winter FSRU over in Egypt.
Okay, that's significant.
It shows their model can still win substantial long-term international contracts in these high-growth, underserved markets. It sort of proves the underlying assets have value despite all the internal financial stress.
That's a strong counterpoint to the immediate financial panic then. Speaking of which, how did they actually manage to shore up their liquidity to survive these debt talks? They must have needed a lifeline, right?
They did. And they executed a very fast, very large asset sale. They sold their Jamaican operations, including the Montego Bay LNG terminal.
How much did that bring in?
Over $1 billion in liquidity.
Yeah.
And the stated primary use for that cash was immediate debt reduction.
Okay, $1 billion is obviously a huge amount. But was that enough to truly stabilize things, given the leverage is still high and free cash flow is negative? Or was that more like triage, just buying them a few more months of breathing room?
Honestly, it feels more like the latter, like triage. It definitely bought them crucial time, and it showed they have valuable assets they can sell if needed. But, $1 billion doesn't magically fix the underlying operational efficiency challenges, nor does it guarantee the debt renegotiations will be successful.
Right.
It just lowered the immediate risk of a complete liquidity crisis before these critical deadlines hit.
Okay, let's turn to the charts for a moment. Because this kind of high-risk, high-reward play often attracts technical traders looking for a sharp bounce. Is there any sign the stock might have actually hit bottom?
Well, technically the picture is quite interesting, especially if you're a speculator. The price is near those all-time lows, which often signals capitulation, like everyone who wanted to sell has already sold.
Mm-hmm.
But if you look at momentum indicators like the relative strength index, the RSI readings, they're starting to climb quite aggressively from really deeply oversold levels.
Okay.
That suggests a potential bullish mean reversion setup might be forming, like it's due for a bounce.
And is the trading volume reflecting that? Is money actually coming in?
Yes, actually. Recent trading volume has surged quite dramatically. That can often be a sign of accumulation.
Meaning?
Meaning potentially sophisticated buyers are stepping in, perhaps aggressively, at these really distressed levels, betting on a turnaround driven by these upcoming catalysts we've been talking about.
Okay, so for a trader getting in now, what are the immediate technical hurdles? Where does the stock need to go to confirm some positive momentum?
The first key level is really breaking decisively above $2. That seems to be the initial resistance. If it can clear $2 with conviction, that kind of opens the door to the next technical targets, maybe around the $3.50 area. And look, if they get a successful debt resolution announcement, that could potentially push it quickly towards that $4 to $7 range, getting it much closer to those analyst targets we mentioned earlier.
Wow. It really sounds like any investment here hinges almost entirely on the news flow over the next, say, 90 days. This isn't a stock you just buy and forget about.
Not at all. You have to watch the news wires daily. Absolutely.
Right.
We have this cluster of potential catalysts coming up very soon.
Like what specifically?
Okay, first, the Q3 2025 earnings release. That's scheduled for November 6th. Management has to use that call to give clear, transparent updates on the financials and, crucially, the status of those debt negotiations.
That'll be critical. What else?
Second, just clarity on the debt agreement itself, whether it's a refinancing, getting waivers, extensions. Any news there will be huge. And third, we should probably expect ongoing news about potential further asset sales or maybe project ramp-ups before the year ends, anything that could improve cash flow sentiment.
And then there's that other layer. We probably can't ignore the speculative buzz floating around online in investor forums and such.
Right.
And we absolutely have to stress these are totally unverified rumors, but they definitely add to the high-risk, high-reward feel of the stock.
Oh, for sure. The speculative chatter really covers the extremes, both worst-case and best-case scenarios. You hear talk about a major debt restructuring, which, could involve swapping debt for equity. Painful for current shareholders, but potentially survivable for the company.
And on the flip side?
On the flip side, the buzz includes rumors of maybe a large private equity firm injecting cash or even, a complete buyout offer from a big international energy player looking to grab these integrated assets cheap.
And even if those rumors are unverified, does management maybe benefit from letting that kind of buyout speculation hang in the air while they're deep in these debt talks?
It certainly doesn't hurt their negotiating position, does it? Speculation about a buyout or a major investment might help put a floor under the share price near these lows.
Yeah.
It also gives debt holders a sort of psychological backup, a sense that there is real underlying value here, which could improve the company's leverage in the talks.
Makes sense.
But, and this is the crucial but, we have to reiterate the primary risk. Failing to file those 10Qs and missing that February 2026 Nasdaq deadline, that remains the single biggest immediate threat to equity holders.
Okay, so let's try and bring this all together. If we're summarizing the investment thesis for someone listening right now, how do we balance that incredible 550% potential upside with the very real, very scary risk of delisting or worse?
Yeah, it really is the textbook definition of a high-risk, high-reward situation.
Yeah.
And it's truly only suitable for capital that you can genuinely afford to lose completely. The risks are profound. You've got liquidity issues, potential execution failures on new projects, and these immediate, intense regulatory and debt compliance pressures. That's the downside.
And the upside.
But the potential reward is equally massive. They have what seems like a protected vertical integration moat in a critical global industry LNG infrastructure. They have exposure to fast-growing emerging markets. And you have those analyst targets suggesting multifold returns if, and it's a huge if, management successfully navigates this crisis.
So who is this stock actually for then? Who should even be considering it?
Well, it seems like it's mainly for two distinct types of investors right now. First, you have the really aggressive short-term trader. They're looking to play the news cycle, seeking alpha from this Q4 cluster of catalysts around the debt resolution and earnings.
Okay. Playing the volatility.
Exactly. And second, you have the truly long-term, maybe deep value investor who passionately believes in the secular growth story of global LNG demand, and they're willing to stomach the incredibly high risk of total loss in the short term.
So they're betting purely on survival first, then long-term growth.
Precisely. They're betting that New Fortress Energy can actually survive the next 6 critical months to ultimately benefit from those multi-year energy transition tailwinds.
Which brings us nicely to our final thought. Despite all this near-term chaos, the volatility, the looming deadlines, the compliance risks, the long-term demand picture for LNG infrastructure globally does seem undeniably bullish, doesn't it?
It does seem that way.
So the ultimate question for you, the investor looking at this, is really quite simple, even if the answer isn't. Can New Fortress Energy survive the intense pressure of the next 6 months to actually live long enough to realize that potential secular growth?